Hi, this is Michael Waits recording live from the Singapore FinTech Festival 2024. Thank you for joining us for this special edition of Insurance for the New Possible, where we discussed the most innovative ideas in FinTech. We are joined today by Chetan Karkhanis, SVP Strategic Ventures at Franklin Templeton. Thank you so much for joining us today at the Singapore FinTech Festival 2024. How are you doing today?
I'm doing great. Thanks for having me, Michael. It's great to be here.
It is our complete pleasure. Look, let's start at a really high level, if you don't mind. What are the four fundamental objectives of Franklin Templeton and its strategic ventures business?
So I'll start with an overview of what Franklin Templeton is about, and then
Perfect.
what Franklin Templeton Strategic Ventures is trying to accomplish.
Great idea.
Most of us know us as a global asset manager. We manage about 1.68 trillion as of the last month of assets.
That's a big number.
Not a good number. Yeah, it's a pretty big number. But we're a traditional asset management firm. We've been around for over 75 years.
Okay.
We have four main objectives within the Franklin Templeton Strategic Ventures Group. The first is what we're trying to do is create the corporate venture capital arm and invest in companies that are of importance to us from a strategic angle.
Got it.
So a lot of new technologies, new fintechs, those are kind of interest to us. The second is building new lines of business organically. So we actually run a few advisor platforms that service the needs of independent financial advisors in the US, Germany, and across the world. So that's another business line we're operating. The third, which is, by the way, the first and the third are really my areas of focus for Asia Pac. The third area of focus is on commercial partnerships with next-gen, non-traditional players. So as a global asset manager, we work with the likes of banks, sovereign wealth funds, retail gatekeepers. That's the core of the business.
Right.
But we don't want to ignore where the market is going and how to service the next generation of investors. So this is where digital banks, robo-advisors, next-gen distribution, embedded finance plays come in. And I'm responsible for the Asia Pac region, for example, to really partner up with companies and try to find solutions for them from a wealth standpoint.
Is the Strategic Ventures Group at Franklin Templeton relatively new?
We only started about 4 or 5 years ago.
Okay, that's great.
Yeah, so it is relatively
And
new.
what was the impetus for that?
Great question. So first of all, our CEO, Jenny Johnson, she's been very passionate about technology. She comes from a technology background. So I think it's a note for institutions out there who are trying to innovate. Unless you have a really passionate leader who is going to espouse, innovation and take that belief system forward, it's not going to trickle down to the next level. So it's largely because of her. Secondly, I think, I used to lead our corporate strategy function at Franklin Templeton in headquarters when I was in the US, and used to do a trends analysis to the board every year.
Oh, you did?
And as part of that, it was all about what are the trends that are impacting a 70, 80-year-old, 100-year-old business like ours, and how is technology impacting that? So we couldn't be blind to what was happening out there in the industry, and we need to react and be organized to react to those trends.
Yeah, it's interesting. Like, I spent my entire career mostly at Morgan Stanley and Goldman Sachs.
Right.
And the idea was to focus, whether from an institutional level or from a individual level, on this sort of baby boomer and Gen X generation. And they kind of invested in the same way with the same ideas.
Right.
But that's been changing a lot recently. And that probably has driven some of the reasons why the Strategic Ventures Group was started, because you've got to be able to access not just new products, but the new investors as well, as they come in with a different mindset and a different outlook. Yeah.
Absolutely. I mean, there's some, don't quote me on the exact source of this, but there's a statistic out there. There are almost 60% of millennials own some form of crypto.
Right.
So if you're not in that asset class in some form, and I granted it's an early, I'm not recommending or making any portfolio decisions here, but if you're not in that kind of asset class and catering to the needs of younger generations, you have to see where the direction is going with wealth.
But I'm sure you remember this, right? Like, until George Soros started the quantum fund in the mid to late 80s, there was no concept of alternative assets.
That's right.
Right? It was stocks, bonds, maybe some options, maybe some commodities, but that was really it. And that ushered in a whole new wave. So crypto or not crypto doesn't really matter to me. It's just this idea of every kind of generation or next generation brings in alternative assets, and whatever they are, you have to have a way to access them.
That's right.
Right? Because the new generation is going to want to do that. So how can business strategically balance the integration of cutting edge technologies like yours, but still maintaining sort of business stability? Right. You know what I mean? Because there's a whole bunch of new stuff going on. How do you integrate that while still maintaining that stability?
So I think this is the classic build, buy, or acquire kind of question.
Yeah, or how
for
do you
most
mix them all
corporations,
together, right?
And how do you sort of create value and drive impact? Ultimately, it is the end game is about driving impact.
Sure.
And making sure you're scaling these, that they're not just experiments, but they're actually bigger than that, and they can actually drive value for shareholders, for clients, for the organization. So actually, I forgot to mention one other piece of the fourth piece actually of our strategic ventures piece, which is the partner programs and incubation programs.
Okay, that's a great idea.
So that's the early entryway into helping identify which fintechs or technologies could be seeded, could be partnered with from a proof of concept standpoint, where we could build interesting experiments, right? And this helps the thought-provoking experiments to get going. The second bit is a program around more larger strategic investments, which was the first pillar that I spoke about.
Right.
Which is, we kind of have an idea of what the strategy is, but we need a player to partner with, either a technology player or a distribution player, to partner with to drive more growth. So we have been actively looking at strategic investments in that regard on how to scale these businesses even more.
How do you decide though? Right, we went through this again at Goldman Sachs a lot.
Yeah.
We know the product that we want to use, but it's going to take us a ton of time to build it. And maybe someone's built 75% of it already and then needs to amend like the other 25% or 15% for us.
Yeah.
How do you balance those two things together? How do you decide like, oh, we should partner with them or we should do it ourselves?
I think it comes down to a case-by-case basis on where, how far along has that other company come along?
Sure.
Is it more relevant? Should we make the case to, nothing's for free. So you have to, when you're trying to tie up with companies, specifically with a strategic investment, it comes down to price.
Right.
It comes down to cultural fit, the team, whether the values and the mission is aligned. So it's not that easy to make that decision.
For sure.
But ultimately, I think it's about, we have a team of investment experts that can look at fintech, see what is the relative value, both from a valuation standpoint, but as well as a business impact standpoint,
right?
And whether it makes sense to partner or not. Otherwise, we'll just build it in-house. And I can't say that all experiments in-house have been successful, because oftentimes most experiments don't succeed.
Right. I mean, by definition, they're experiments.
Right. And but it's not an easy question to answer because, one, it requires patience.
Sure.
Right. Management teams expect fast turnarounds and results.
Right.
But it does require a longer runway and patience to deliver those results. Two, there's always a price to pay. So what that valuation you're paying for, whether there's a trade-off in taking a stake versus building it in-house, we prefer to sort of objectively look at that decision tree. But I think organizations should do that. And I think the third bit is the strategy playing out as it should?
Right.
And when to cut losses if you need to cut losses.
Sure.
I don't know if we've necessarily been great at that, but I think we are at a point where we are taking a more closer look at what are the experiments that have worked in the last 10 years, what haven't, and where we need to cut losses.
Yeah, my first trading manager told me, let your winners run and cut your losses really fast.
Just like a portfolio.
Exactly. Yeah. So let's talk a little bit about embedded finance. It's becoming way more essential, particularly in reshaping customer expectations.
Yeah.
How can established financial institutions build these embedded products, and how do they create better customer experiences?
Sure. I think from an embedded, the importance of embedded finance is really that it's an expansion of the distribution network for most firms. We have traditionally been in a world where, we're retail or institutional,
right?
At least from an asset management standpoint. It may differ from business segment to business segment.
Right.
But how about thinking about more non-traditional players and next-gen players that are not necessarily a bank or a wealth manager? How do you engage with them? So I'll give you an example that we've partnered with. Wise is a neobank out of the UK.
Yep.
They essentially offer payments and remittances. They're a wallet. But every wallet has cash, and that cash needs to earn some sort of liquidity yield. And we came in and went, well, look, we've got a great solution for this. We have a simple money market fund. We can embed that. It is a simplest form as embedded finance as you can get.
Right.
Because ultimately it's taking what is a payments business or remittance business into a wealth play. From that, we've sort of expanded into a slew of different tech-enabled solutions, like our goal optimization engine for wealth planners, or our advice-based embedded tools, right? So I feel like embedded finance it's like the chip in a computer. You can put in different APIs, you can put in different chips to enable wealth to happen. And I think that's the exciting part of this.
So this is one of my
partnership.
most recent favorite implementations of embedded finance. By the way,
Yeah,
you're right. Wise has cash in it,
right.
and everybody has different currencies in it. But at the end of the day, there's cash there.
Mhm.
If I'm an Irish guy, I've got euros. I don't know what currency they use. If I'm in Japan, I've got yen.
Yep.
If I'm in America, maybe I have a balance in dollars.
Yeah.
I'd love to be able to take that cash and put it into the S&P 500, because Franklin Templeton should allow you to do that.
Sure.
Right? Because you have ETFs or whatever that does that kind of stuff. That is an awesome experience, no?
I absolutely think so. I mean, and there was a period of time where there was super apps in Asia
Right.
and actually across the world that were coming about. I think Grab had made a foray into this. Razer had even at one point, the hardware gaming company, had a Razer Pay and FinTech initiative.
Yep.
So I just think it's, institutions are thinking out of the box and figuring out, well, there's a lot of liquidity and cash and movement. How do we actually offer different services at the same time,
Right.
beyond our core business?
But up until now, it's been hard to do that in an optimal way, right? Because just moving the money around had traditionally just been hard. But
Right.
now technology allows us to do it in a way that's much easier. I love this idea.
Yeah, and I think it's all because you can invoke APIs, you can create solutions that are, you can create model portfolios that can be invoked through APIs, you can create baskets of thematic stocks.
Right.
There's a range of products.
Is there, not to put too fine a point on it, but is there a financial inclusion angle here as well? In other words, I don't need $1 million to open a Wise account, right? And if I can just, again, take a little bit out bit by bit and put it into even just a money market fund, I can earn a higher return than if I just leave it sitting there. And if everybody has a cell phone, well, then they can have that. How does that work from an inclusion standpoint?
Well, I'll give you an interesting example here in the context.
Please.
So I absolutely believe that, yes, inclusion, is particularly among the emerging markets and third world developing countries, is the embedded finance play, starting with payments and just moving money around, has such a tremendous impact on the ability to now provide embedded finance in the form of wealth or savings.
It does.
But I'll give you a more simple example in the US.
Okay.
It's our Benji tokenized money market fund, on-chain money market fund registered with the SEC. With the Benji app, you can invest as little as $20. You get daily yield accruing to your balance. So your balance is growing every day. It's airdropped to you on your mobile app. And you can make peer-to-peer transferability of these tokens if you need to pay to someone else within the ecosystem, within the Benji ecosystem. It's an independent app at this point, but it sort of brings together best of both worlds in terms of payments, the yield as well, and the ability to sort of service a larger base of clients who may not be able to access such traditional services.
What's the relationship between all this innovation that's happening in wealth management and insurance?
That is, so one of the things I love about, and I thank you again to Chubb for hosting me on this panel. What I like about some of the embedded finance plays that insurance has created is, like, for example, I can go I can book a ticket on a travel app and I can get an insurance offering through it.
Easy.
Right? That is a kind of embedded finance play that back in the old days would not have been easy to do.
Really hard.
Now, with wealth and insurance, I think the most relevant area of focus is on the investment-linked products, which has been an area where it's been a much more high-touch sale by client advisors or relationship managers, but it could be much simpler. Insurance could be simplified for the common man. You need a life plan. You need some sort of combined investment and wealth play. I think this is where the combination of insurance and wealth, comes really handy, because within an investment-linked product, it's actually an asset allocation plan that manages what kind of portfolio is running in the background with an insurance overlay. And hence, I think there are many possibilities to make it micro as well as a little larger in terms of the affluent spectrum. But I feel like there is a natural correlation between where insurance companies are trying to expand their distribution, as do wealth managers like us.
You talked a little bit about tokenization earlier.
Yeah.
Do you think there's some way to include that in these types of products as well? We're not there yet. Yeah, but in the future, we should be able to get there, right?
Yes, but if you can tokenize a money market fund into a share or into a token, and you can tokenize a insurance contract, which is in effect a smart contract, then then the combination of the two should be very programmable and easy to do into an investment-linked product.
I like it.
Or insurance-linked product.
So how can, with all these things changing in sort of the wealth management and financial services industry, right? How do asset managers remain relevant as long-term secular trends like demographic shifts, lifestyle changes, all the things we were talking about before, the differences between, baby boomers, Gen X, millennials, Gen Y, Gen Z, reshape the finance industry? How do you stay relevant?
Well, this is the question at the top of my head every day as I wake up and before I go to sleep, basically. It's the reason for my existence.
Right. Am I okay?
I've been thinking about this question for the last 15, 20 years. Like, how do asset managers stay relevant and stay at the cutting edge of technology or at least a user experience that the next generation of investors want to use?
Absolutely.
Right. And I think we have to stay. So it's a foregone conclusion that we cannot just stay the same. We can't just rely on the old 40 Act fund, the mutual fund, or even ETFs for that matter.
And it's true for every industry, right? It's not just true for finance.
Yes.
Car companies are changing, airplane companies, everything's changing, right?
The only difference between us and, we are talking about huge sums of wealth across the world.
Sure.
Almost 120 trillion when you look at it across illiquid and liquid assets.
Right.
And that wealth today is stored within incumbent players like banks, and it's still only a fraction that's stored within next-gen platforms. If you want to consider that as a robo-advisor or a neo-brokerage or a digital bank, we haven't even scratched the surface. The entire robo-advisory market is about 1.4 trillion of assets, give or take. That's not even 1% of the overall wealth. And
it's growing
market.
really fast as the rest of the world gets wealthier, right?
Right, and and since COVID's actually been a boon to the change, because more people are engaging with financial services in a digital way, and engaging with very slick, very cool user interfaces of apps. I could list out a bunch of them that I use.
Spending a couple of years at home will force you to figure out how to do stuff digitally, for better or for worse, right?
And also engage with the stock market when you're stuck at home,
exactly.
which I think volumes have come down since then. But brokerage, neo brokerage is still a huge area of growth for the markets across the world.
Yeah.
And then an expansion of that is asset classes like crypto, alternatives. You mentioned alternatives earlier. I don't want to neglect that because as equities become a little bit more correlated and tightly benchmarked, alternatives present a more uncorrelated asset that can provide some interesting returns.
Alpha generation.
With lower correlation to equities, for instance.
Right.
But so I think, that price point of being able to offer alternatives to mass market or affluent has already come down either through tokenization or special purpose vehicles. So that's another area of interest in terms of how asset managers can tap into the broader wealth.
So I have two more things for you before I let you go.
Sure.
We spend a lot of time talking in the insurance industry in particular about building customized and personalized and maybe relevant products for people. How do we do that in the wealth management space, right? In other words, you and I may have the same income, we may be the same age, but like you may have no kids, or I may have 3 of them, or I have adult. Like, how do you build, or can you build customized wealth management products today or going forward, the same way that the insurance industry is trying to address that?
I feel like you've been inside my head or something, because this is what I've been exactly doing for the last 4 years. Is one of the main. So personalization, AI, and dynamic allocation are 3. They're not just buzzwords. They already exist. We can actually do it for clients today.
Yeah.
And I don't want to be, sitting on a pedestal preaching our own product here, but we have developed in-house something called the Goal Optimization Engine at Franklin Templeton. And this is exactly what you described. You and I could be the same age. We could have sort of different goals. We could have different circumstances. we shouldn't be having the exact same portfolio, even if our risk levels were exactly the same.
Exactly.
That's because our time horizons might be different. Our
Right.
infusions or withdrawals might be different.
Yep.
So how do we have all
I
the
may be
technology.
taking care of another family, like my mom and my dad, and you may
Right,
not be, right?
right.
So all these things could be different.
Right. We may have, you may have 2 goals. I may have 4 goals.
Right.
I may want to maximize across goals. So how do you actually make all that experience, both for the advisor, maybe we use advisors, maybe we do it ourselves. How do you make it more intuitive, and personalized, but without complicating the matter? So I think there's a lot of technology underneath that. There's a lot of ability to code dynamic programming or even quantum computing. I know this conference has all been about quantum, which allows for much faster processing of permutations and combinations. So that's an interesting area. But to answer your question, Michael, I think it's already here.
Okay.
The problem is the adoption. The problem is how many advisors are willing to, maybe not a problem, but the challenge is, to start working with these kind of tools, these kind of platforms, and really use it on a day-to-day basis.
Okay. Lastly.
Yep.
As this new generation of investors starts to accumulate their own wealth and starts to invest in whether it's traditional assets or alternative assets, how do you build trust with them? And I'll put it all in this context. In the old days, right, you had this fancy office, nice paneled walls and everything. They come in, it feels really stable. But today, they're just transacting on their phone when they're on their train or on the beach or doing. So how do you build that trust with them?
Yeah, I think...
Am I reading your mind again?
These are all very topical questions because this is exactly what we're trying to solve for, right? Like a lot of the next generation does not want to have the same advisor or institution as what their parents did.
For sure.
But how do you remain relevant as an institution that is trying to offer those services? And I think this is where, first of all, regardless, there is still a level of brand recognition and trust that goes behind a 75-year-old institution like ours. And I do think maybe we're overglossing the importance of that or underemphasizing the importance of that. But I don't think we should just rest on those laurels. We need to, as across institutions, across the industry, develop the right products and services for the clients and remain fail-proof and secure. Because I think for the next generation, the main key is ease of efficiency of transacting, engaging with their apps or their mobile phones. And that's probably the most important aspect, right? But I also think they are looking for some sort of hybrid human and technology touch. So there has to be someone at the back end who can say, okay, if you need help, I'll be there.
I'll be there for you.
And we've got your back when things don't go the way you expect to. Right?
Awesome. That's a perfect way to end. Chetan Karkhanis, SVP Strategic Ventures at Franklin Templeton. That was awesome. Thank you so much for doing this today.
Thank you, Michael.